With inflation on the rise, many of us are feeling the pinch in our wallets. But what about student loans? How is inflation affecting this already difficult financial burden? Student loan debt is a heavy burden, and is no wonder why so many young people are struggling to pay off their loans. But did you know student loans can also play a huge impact in further enhancing the current global economic crisis? Hey there everyone! Welcome back to another video on Business Ville. In today's video, we're going to explain the current critical condition of the global economy and how student loans can further make the situation more critical. Stay tuned and let's get started. The critical condition of the global economy since the pandemic. The global economy is facing a difficult time. The cost of living crisis, tightening financial conditions, Russian aggression in Ukraine, and the ongoing COVID-19 pandemic are all weighing heavily on the outlook. Global growth slowed down from 6.0% in 2021 to 3.2% in 2022 and is forecasted to slow down to 2.7% in 2023. This is the weakest growth profile since 2001, except for the global financial crisis and the acute phase of the COVID-19 pandemic. Global inflation is also forecast to rise from 4.7% in 2021 to 8.8% in 2022, before declining to 6.5% in 2023 and 4.1% by 2024. To ensure a strong recovery, policymakers need to take decisive action. Monetary policy should stay the course to restore price stability, while fiscal policy should aim to alleviate the cost of living pressures while maintaining a sufficiently tight stance aligned with monetary policy. Structural reforms can further support the fight against inflation by improving productivity and easing supply constraints. Additionally, multilateral cooperation is essential for fast-tracking the green energy transition and preventing fragmentation. So, how do student loans impact the current situation of the global economy? Reduces the expansion of new firms. Student debt is a problem because it can stifle economic growth and productivity. The evidence is clear that having a high amount of student debt can lead to a decrease in the number of new businesses being started. This is because student loan borrowers have less capital available to them to pursue entrepreneurial projects. The issue of student debt is especially concerning for student loan borrowers who are unable to pay off their loans. According to the Consumer Financial Protection Bureau, student loan borrowers in default owe an average of $30,000 in student loan debt. This amount of debt can be a major obstacle in starting a business, as it leaves borrowers with limited capital to invest in their venture. Student loan debt can have a long-term impact on borrowers' finances, long after the borrower has graduated. Reduces the percentage of homeowners. For many college students, the prospect of taking on student loan debt can be a daunting one, and the EDI data have highlighted just how much of an impact this has on their ability to purchase real estate. With nearly 44 million Americans holding student loan debt, it's no surprise that many graduates are opting to put off buying a home until they have paid off their debt. The responsibility of taking on student loan debt is not to be taken lightly. On top of the monthly payments, there is the risk of defaulting on the loan and damaging your credit score. This can make it incredibly difficult to buy a house in the future, even if you do manage to pay off your debt. This is why so many graduates are choosing to live with their parents until they can purchase a home or even rent an apartment. This decrease in homeownership has a significant impact on the economy. Banks and investment firms are not able to make as much money from mortgages, which leads to a decrease in revenue. This decreases the amount of money that can be used to fund other projects, such as small businesses and infrastructure, leading to a decrease in the overall financial well-being of the economy. Makes it more difficult to survive a recession. Carrying high debt can be an overwhelming feeling, especially when times of economic distress like the Great Recession in 2008 or the COVID pandemic hit. It can feel like you're sinking into a sea of debt with no way out. But It's important to remember that there are ways to stay afloat during these trying times. Building an emergency fund is one of the most important steps you can take to make sure that you're prepared for any economic shocks that come your way. What impact will future student debt have on the economy? When it comes to student debt, it's a case of for better or worse in the economy. It has become a major burden for millions of Americans and has significantly impacted the economy. Student loan debt has risen to an all-time high and is now the second largest form of consumer debt, following mortgages. Unsurprisingly, this has caused a ripple effect in the economy. Sure, loan forgiveness could provide a short-term economic boost, but we need to address the cost of college. That's why tuition-free or debt-free colleges are the way of the future. With more affordable and accessible higher education, we can give current and future students a break and the economy a long-term boost. It's no secret that inflation and uncertainty have been on the rise, and it's only getting worse. Student loans are making it increasingly difficult for young people to get ahead, and this is having a real impact on the economy. We hope you found this video insightful. Thanks for tuning in. Don't forget to like, comment, and subscribe for more videos like this. Stay informed and stay safe.